So the market continues to rip as it is clearly digesting the Delta variant as something that is passable. Bond prices have hit resistance while the stock market continues to go up, which means that investors are likely buying less bonds and more stocks at the moment. We are continuing to see money pour into the value stocks that we talked about, as well as the hospitality reopening trade. So in this video, I'll give you a review of all the stocks that are looking to rip higher. There are a couple in particular that look extremely juicy here at the moment. We will get into those. I'll give you an update of the current plays, but first we will start with a general market update, and then I'll get into those stocks as usual. Welcome back to The Traveling Trader, your source for non-BS, concise, regular market updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what stocks you are playing. I always like hearing from you guys. I read all of the comments. I respond to what I can. And without further ado, let's get right into it. So the S&P 500 bounced off the 50-day moving average. As I said in yesterday's video, it did this 8 times already in 2021. We actually gapped up today, which is a strong sign that this was not a dead cat bounce. Now, everybody and their mom is predicting a market correction at some point, and I do think that it is likely within the next couple of months, if it is going to happen at all, only because the summer months are usually the slow months, and we also have to contend with the Delta variant as well as a slowdown of the economy post-pandemic. However, earnings season is underway as well, so we do have those two competing factors. And if Chipotle is an indication of how earnings is going to go, then we might see some of these major blue chip companies gap up higher into all-time highs. Chipotle is up almost 10% today after a couple of price upgrades as well as increased guidance. We bought Chipotle back on May 12th. We're now up almost 28% on it. That wasn't the only stock we bought back then. We bought Tesla, Palantir, NEO, AMD, QQQ, BA, Shop, Sony, Walmart, etc. You can see the whole list on the screen right here. If you want access to all of our trades, link is in the description below. But as I said in my last video, trying to predict when the market is going to crash and making investment decisions based off of that, you are likely to miss what are called the best days in the market. If you're trying to time the market based on a day-to-day movement, you are better off trying to find value and investing in that value when the opportunity presents itself. That doesn't mean you blow your whole wad on your favorite stock at the all-time high at one price point. However, it does mean that you can pick and choose certain stocks, as we've been doing throughout all of our videos. Go back and watch all of them. We've been doing that on stocks and really being picky and selective about what we invest in, especially as the market continues to melt up. If you watched my video from a couple days ago, I said Carnival Cruise Line was at an optimal point at the bottom of the trend line. We bought that. We are now up over 10% on this just in a couple of days. Jets also bouncing nicely off of the 300-day moving average here. Now, we bought a bearish diagonal spread on Netflix after it almost hit the top of this channel here leading into earnings, thinking that Netflix would actually have to blow earnings out of the water in order to break through resistance here, because it is seen as a stay-at-home stock, or somewhat of a stay-at-home stock or a hybrid. And there's increased competition from other streaming services, mainly Disney Plus, which continues to blow through record numbers. We are now up 256% on that Netflix bearish play. And we still have some of our hedges open against the QQQ, which is the ETF that tracks the NASDAQ. Just in case we do see a downturn in the coming days, I don't want to have all bullish plays in this market environment. So we have a few of those spreads open. I do also have a bearish spread on Nike, since Nike did gap up, hit all-time highs, and is now consolidating up here. So I need Nike to really finish below 159. We are currently down on that spread, as I said yesterday, but I'm likely going to hold this for another few days and see how the market shakes out. So there's the market update. The S&P 500 actually looks like it's on a general trend. You would not even know that there was really a COVID variant, minus the short blip here, but the trend is almost one straight trend line going all the way up, melting up, continuing to melt up as the economy reopens. So what stocks are we not in that I'm looking to get into? Well, there are a couple. One of them is ChargePoint, CHPT. I've talked about this numerous times on this channel. Why am I talking about it again? Well, it is currently in this channel, and it's clear that it's been in this channel really since February 2021. And we have hit the bottom line of this channel 3 times. We are at it again. Now, you can't really see it because it's obfuscated here. However, if I delete this trend line, you can see what is under there. There is the 300-day moving average that is following that trend line exactly. So because it is at the bottom of that channel, it's at the 300-day moving average. It is almost oversold on the RSI as well as the MFI. The fact that the infrastructure plan is still in the works and it has not been announced yet In my viewpoint, ChargePoint is going to be a cornerstone stock of that infrastructure plan, as I said before. We have swing traded it before, and this is an optimal entry point for ChargePoint here because you could set a stop limit right below the support level here and exit relatively unscathed if things don't go our way and or the market turns. Another thing that's attractive to me about ChargePoint is its days to cover. Now, the short interest in terms of a percentage might not be that high. It's around 9% at the moment, but there are 4 days to cover, meaning that if shorts were going to cover on ChargePoint, it would take 4 days, which is relatively high for a stock. Aside from potentially being a cornerstone stock in an infrastructure plan, it also has a 7 buy rating on Ortex. If we move over to tip ranks, you will see that ChargePoint is rated as a strong buy as well. In the last 3 days, it maintained a buy rating from Needham, Roth Capital, and Oppenheimer. Another stock that I'm looking at right here is a stock that I've held for a very long time, and it recently did a 4-for-1 split, and that stock is Nvidia. It hit almost the 50-day moving average, dropping 15% pre-split to the 178 range, at which point we bought leaps on it and then also sold poor man's covered calls in the 190 range. Now, we could get a sign on those calls, but if we did, we'd be making $20 per share after exercising our leaps. And if I'm speaking Spanish and you've always wanted to learn how to trade options, there is a link to a beautiful course that I put together. I spent over 100 hours putting this course together. You could definitely check it out. You can also learn how to trade options for free, obviously, but if you want access to that course that I put together where I talk about every single strategy in a consistent manner, link is in the description below. Be my guest. But I think if you can afford it, selling covered calls or poor man's covered calls against your leaps on Nvidia here makes sense. Otherwise, you could dollar cost average after this 15% drop. We usually tend to see violent spikes post-split on high demand stocks like Apple and Tesla. We will likely see that on Nvidia too. And Nvidia will likely be a 200 plus stock in the midterm. Another stock that I'm looking at is Harley Davidson. Harley Davidson, in typical fashion, crushed earnings, and then we saw it tanking 7% today, almost falling to the 200-day moving average. It actually fell to this level a few times on this run up here, but Harley Davidson was trading at almost $52, $53 not that long ago. It is a reopening value stock that also pays a dividend. However, I would wait for it to find support here, see if it finds support near the 200-day moving average before jumping in. And the last stock that I'll talk about is Caterpillar, currently sitting at the 200-day moving average for the first time in a very long time, going back all the way last year. It has earnings coming up towards the end of the year, or towards the end of the month. We do have a diagonal spread on Caterpillar that is currently up 15%. It also pays a healthy dividend of $1.11, which is crazy compared to the price. It is also likely to be a huge part of the upcoming infrastructure bill, and it maintains an A+ profitability rating on Seeking Alpha. And because of its strength and generous dividend, it's a great stock to play the wheel strategy on, whereby you sell cash secured puts. If you get assigned, then you can hold the shares, potentially get some dividends. You can also sell calls against those shares if you do get assigned. Anyway, Google the wheel strategy. It's also detailed in the options course, but you certainly don't have to play it if you want to play Caterpillar. You could play it as just a regular stock. But sitting at the 200-day moving average, I like it for the long term. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know which one of these stocks you are trading. If you want access to all of our trades, the link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.